When it comes to taxes, what's the single most important number? You guessed it, your taxable income. Everything, and I mean everything, starts from there. But how do we actually get to that number? Well, today we're going to dig in and break it down step by step.
It seems like a pretty basic question, right? You earn money, you pay tax on it. But is it on every single dollar that hits your bank account? Or is it what's left over after you've paid for things? That little detail is exactly where a lot of the confusion comes from.
And believe it or not, the entire official answer is hiding in plain sight, right here in this one sentence from Section 9 of the tax code. Yeah, it looks a little intimidating, full of that classic legal jargon, but don't you worry, our whole goal today is to decode this thing and make it crystal clear.
Okay, let's roll up our sleeves and take that sentence apart. We're going to pull out the two most important ideas and figure out exactly what they mean. Once we do that, you'll see that this complicated text actually starts to make a whole lot of sense. The very first key phrase we need to understand is total income. This is our starting line. It's every single penny you get during the tax year, before anything at all is taken out. So, to put it another way, just think of it as your gross earnings. It's the whole pot of money you start with. If your salary is $50,000 and you get a $5,000 bonus, your total income is $55,000. Simple as that. It's the big number we begin with. All right, now for the second piece of the puzzle, deductible allowances. If total income is what you add to the pot, these are the very specific things the law says you're allowed to subtract from it. Their only job is to lower that total, which, of course, lowers your tax bill. In simple terms, these are your legal deductions, and it's really important to know they aren't just any expense you happen to have. They're the specific subtractions that the tax code explicitly says, yup, you can count this. That distinction is crucial. And right here, the law spells out the exact math for us. It says total income is reduced by deductible allowances. It's just simple subtraction. Total income minus your deductible allowances, that's the core of the formula. But hang on, we're not quite done. Tucked away inside that legal text is a tiny little phrase that is so important. It's easy to overlook, but it acts like a critical safety net for this whole calculation. You see it there in parentheses, but not below zero. Okay, what in the world does that actually mean? Well, this little phrase creates a hard and fast rule that acts like a floor in our tax formula. Let's look at a quick example to see it in action. Let's say your total income for the year was $50,000. But maybe you had a tough year in your business and ended up with $60,000 in deductions. Logic might tell you your taxable income is now negative $10,000. But the not below zero rule kicks in and says, nope, your taxable income simply stops at zero. You can't go into negative territory. So here's the bottom line. Your taxable income can go all the way down to zero, but it can never, ever be a negative number. This is what we call the zero floor. It is the absolute lowest your taxable income can possibly be, no matter how huge your deductions are. So now that we've broken down all the pieces, we've got total income, we've got deductible allowances, and we've got that zero floor rule, let's put them all back together into one simple, clear formula that you can actually use. It really is this straightforward. Step 1, figure out your total income, that big starting pot of money. Step 2, add up all your allowed deductions and subtract that total. And for the final critical step 3, check your answer. If it's a negative number, your final taxable income is just plain zero. So why did we just spend all this time dissecting one single sentence? Because this definition, it isn't just some random rule. It is the absolute bedrock of our entire personal income tax system. Everything else is built right on top of this. So let's boil it all down. What do you need to walk away with? First, the core formula. It's what you earn minus what you can legally deduct. Second, remember that safety net. Your taxable income can hit zero, but it can never, ever dip below it. And finally, just know that this simple idea is the foundation for everything else in personal income tax. And that leaves us with one last big question. Understanding this formula is the first step, sure, but applying it is what really makes a difference. Since every single dollar of deductible allowances directly lowers your taxable income, the real question for you is, are you making the most of every single one you're entitled to? That's definitely something to think about. Thanks for joining me for this explainer.